Good morning once more. It is a pleasure to be here in Cartagena. As I said, this is one of my favorite places in the world, so it's a double pleasure to be here. Thank you to the SAHIC team, Arturo, Florencia, Veronica, for inviting me to be here in this occasion. So today I'm going to talk about the global outlook that we're facing this year and also the impact of that outlook for Latin American countries. So let me start with the global outlook. After the strong recovery that the global economy witnessed in 2021 and 2022, the global economy is going to decelerate and is decelerating this year. This is due to the rollback of the stimuli that were implemented during the pandemic, but also due to other shocks like the war in Ukraine that still ripples we can feel the ripples of that in the global economy. Advanced economies are the first to decelerate because of the rollback of stimuli, particularly the rollback of monetary policy and the cycle of increases in interest rates. However, China will grow more than expected this year because of the lifting of all the restrictions on that were imposed during the pandemic, even if they have episodes of COVID. So that will propel growth for the global economy. There's always this discussion about whether there's going to be a global recession or not. Our baseline scenario is that there still can be a soft landing of the global economy. And what we've seen over the past few months is that employment levels remain solid in the US and in Europe, and also activity decelerated less than expected. So there was not even a technical recession in the last quarter in advanced economies. So that gives us certain confidence that still a soft landing of the removal of these stimuli is possible. However, markets still anticipate that there could be a recession, and that is what we see in the last chart here, whereby the yield curve is still inverted, pointing that there's going to be a recession, so that interest rates will be lowered in the future. So that is still a persistent risk. However, there's some good news. Some of the disruptions in global value chains and the soaring commodity prices have more or less normalized. We see in this chart that to the left that in the US, the backlog orders and the times for processing orders have. At the same time, the shipping costs that soared due to the problems in ports and airports that we saw during the pandemic have declined to pre-pandemic levels. And at the same time, commodity prices are declining, particularly energy prices. Even though some prices still remain above pre-pandemic levels, prices are not increasing, and this is good news. All this is good news for what? For inflation, of course. That is one of the problems that still linger after the pandemic. And we see that in advanced economies, inflation is starting to decline. How fast and to what levels inflation is going to converge? Well, we expect that it converges to the targets established by central banks, but how long this is going to take is still uncertain. But the fact is that even if inflation is coming down, central banks are expected to keep interest rates high. Here in the chart to the right, the dots represent the mean expectation of where interest rates should be according to the members of the Federal Reserve Board. And what we see is that for this year, every meeting and in every quarter, they expected rates to be higher, and now they're expected to be around 25%. However, there are some considerations about that, and we had a financial problem recently. We had the failure of three regional banks in the US, and what that produced was a decline in the market valuation of those banks. And we don't know yet if that problem could be systemic and affects other banks in the future. The Federal Reserve was very swift in terms of action and providing liquidity and making depositors whole. This was a different kind of intervention compared to what we had in the financial crisis a decade ago. But this has calmed markets, at least for now. However, and this is what I'm showing in these two charts, on the left-hand side, we see that there's been a secular increase in the fraction of treasuries and mortgage-backed securities in the portfolios as a percentage of the portfolio of assets of banks. And this is a problem, and this is what triggered the failure of Silicon Valley Bank, because they had 50% of their assets in treasuries. And as interest rates increased and they didn't have secured deposits, there was some kind of panic. Why? Because when interest rates increase, the value of those treasuries falls. And if there's a massive withdrawal of deposits, you can be in big trouble, and they were, and that's why the bank had the massive run that it had. So there's still a large fraction of banks that have this type of problem. We still don't know yet to what extent. And on the other hand, there's a large fraction of banks with unsecured deposits. So the combination of these two things is a matter of concern. However, the larger banks are more protected. The regulation for larger banks did not change. It was relaxed in 2018 for a medium-sized bank, but not for the larger, more systemic banks. However, we still don't know what is going to happen. We hope that markets remain calm as they have been recently, but still there's some risk. So going to what happens in Latin America. I think last year we were talking about or expecting a growth of about 2.7% for the region, and the final outcome was much better. We had growth of about 3.7%. So the combination of, as we'll see in the following chart, the combination of speedy recovery in 2021 and 2022 had produced that the region recovered activity levels before the pandemic for most countries. The recovery, of course, was uneven across countries. If you look at these numbers, we had very different results in terms of growth, and that depended on the role of stimuli in the economy, of the withdrawal of stimuli, but also the exposure to the most affected sectors. So we can think at this point of the pandemic as a transitory shock. In the beginning of the pandemic, we thought that, Latin America is vulnerable to external shocks. This is going to last, for a long time. We're not going to be able to recover GDP levels before 2024. And by last year, most countries had recovered growth. And there's something interesting here. If you look at the chart with GDP levels, those dotted lines represent potential output approximated by the trend. So we're pretty much close to the trend that we were running before the pandemic. That is very different compared to what happened after the decline or the end of the commodity boom about 7 years ago, where growth did not go back to its previous levels. And that is a problem for the region. That was more of a permanent shock, and that is related to the loss of productivity. And this low productivity in the region is one of the things that drags growth down, and that is going to cap any possible faster growth in coming years. Actually, we're expecting growth this year to be quite low, about 1%, and recover to closer to 2% in coming years. But that is a low growth rate for developing economies, especially if you want to converge to higher income levels. The high income levels of developed nations are growing pretty much at that rate. So convergence is going to be more difficult because of this low growth related to low productivity in the region. So after the pandemic, as I said, most sectors in economies, in the economies recovered. That recovery was uneven. First, the manufacturing sectors, the foodstuff sectors recovered faster than services. Now, most services have recovered to pre-pandemic levels, but that is not the case of tourism in several places, particularly in the Caribbean. We are below pre-pandemic levels in terms of international tourist arrivals. We expect this to improve this year, but we're still not completely out of the woods in terms of tourism flows to the region. So considering this whole panorama of a weakening global outlook, if not a global recession, but definitely a weaker global growth, how is the region going to fare, especially if there's market volatility? And over the years, and this is something interesting as well, the region has been vulnerable to external shocks, but right now the situation has moderately improved. If we look at the results of current accounts, after the pandemic, current accounts have been reducing. Current account deficits have been reducing especially for net energy importers. It's still high in certain countries. Chile still has a deficit of 5%, and some Caribbean countries have chronic higher deficits, but the situation is better than compared to the pandemics. And for net energy exporters, the situation is still good, provided that energy prices increased worldwide. But not just that. Portfolio flows to Latin America and FDI flows have remained kind of stable throughout this whole ordeal, particularly during the height of the beginning of the conflict of the Ukraine war. Some of those portfolio flows that were invested in emerging Europe went to more secure emerging markets, so Latin America benefited from those flows. At this point, they have pretty much normalized, but capital flows to the region remain relatively stable, and we have less exposure stemming from current account deficits. And on the other hand, most countries have solid reserve, international reserve levels. And the combination of less needs to import capitals due to lower current account deficits, higher reserves, and international capital still flowing make Latin American economies in general less vulnerable to shocks. And here we have the change that took place in stock markets in Latin America during the height of this recent volatility episode. And it was, of course, also very transitory, and exchange rates in the region did not increase by much. So even if there was a panic and there was some flight to quality or to safe havens in international markets, the region performed fairly well throughout this episode. Okay, so the other good news in the region is that inflation is also coming down. As we saw, that was the case for advanced economies. It is also the case for Latin American economies. And In most countries, this is related to an improvement in monetary institutions, autonomy of central banks, and anchoring of expectations. Central banks in Latin America were the first to start increasing interest rates in the world way before the Federal Reserve or the European Central Bank did, and that helped anchor expectations, and inflation didn't go up as much as it did in some advanced economies, at least in several countries. However, inflation is still high, and food inflation and energy inflation is still high in the region, and that of course affects the more vulnerable households in the region that still need to be protected. And still, what started as an increase in food prices and energy prices pretty much has translated to most prices in the economy. And here in this chart, what we see is that there's a larger fraction of items of the CPI basket that is growing faster than the ceiling of inflation target in most countries. And because of this, because of the spread of inflation to most CPI basket items, central banks are expected to keep inflation rates, to keep interest rates high for a bit longer. Moreover, even if if headline inflation is starting to decline, agents still expect inflation to close this year above central banks' targets. So the combination of still high inflation and re-anchoring expectations to targets will make central banks keep interest rates high this year. However, the cycle of reducing interest rates is expected also to start in Latin America, maybe before advanced markets, because we started earlier increasing interest rates and because inflation could go back to targets faster. We're still uncertain about this, but it is what we expect for this year. So interest rates could start to come down by the end of this year. However, they will remain in a restrictive position for this year before central banks ensure that expectations are properly anchored. And in terms of another key aspect in Latin America, fiscal policy. When we think about fiscal policy and when we think about debt in Latin America and when we think about the pandemic, it's, another debt crisis. Well, that didn't happen, fortunately. Fiscal institutions also improved, and there was prudency in terms of the handling of the stimuli throughout the pandemic, and a large part of the fiscal stimuli were rolled back in most countries, if not in 2021, in 2022. So most countries still have a way to go in terms of the adjustment that they need to do to stabilize debt, which is what we see in this chart on the right-hand side. However, debt levels are high in several countries, not as high as in advanced economies, but we still have less income to deal with debt, less taxes, I mean. So there's still work to do if we want to stabilize that in coming years and increase fiscal space for dealing with future shocks. There are pockets of vulnerability. We still have Argentina that needs to do a large adjustment and still has high debt levels, and most of the debt is in foreign currency. If we compare Argentina to Brazil, a big difference is that 95% of the debt in Brazil is in domestic currency, and that is easier to handle that than if your debt is in foreign currency. There's also El Salvador, Bolivia, and Venezuela with high exposure to foreign currency debt. They're indebted in a currency they do not produce, and they need to somehow obtain those resources to pay up that debt, and with external conditions coming a little bit more difficult, that could create space for vulnerability. But in general terms, the region is not necessarily on the verge of a debt crisis. Of course, there's still work to do. And if we look at these graphs, what we see is that since the financial crisis in the last decade, it was the first time that governments actually were able to implement counter-cyclical fiscal policies in the region, which was an interesting development due to the improvement of fiscal institutionality. But as time goes by, the average increase in spending did not go back completely. And for instance, if we look at the case of Brazil, in every crisis, the average has gone up. It has not completely been reverted. And even if at this point, most of the stimuli were rolled back, probably it's going to stay at high levels. So you need to adjust either by reducing spending, and there's a lot of social pressures not to cut spending, so you need to do it by taxes. But for some countries, it's not that easy. I mean, of course, there's a lot of space, particularly in Andean countries, to increase taxes, but we've seen the problems that have arisen in Colombia, in Ecuador, and in other countries when the governments try to advance a tax reform. So that is not easy as well. So if we want to improve welfare, if we want to spend more in infrastructure, we need to tax more. That's unavoidable, because otherwise, it becomes unsustainable, and we've had the consequences of debt not being sustainable in the past. At this point, again, several countries look kind of out of the woods, considering the plans that governments have for fiscal policies in the future. I mean, of course, this can all change, but so far, debt will likely stabilize within reasonable levels in most countries. As I said, Argentina is still of certain concern. I don't have El Salvador here, but I mean, the trajectory of the debt would be upwards, I mean, according to our last exercise. And debt levels in Brazil are likely to stabilize, but at very high levels, at 90% of GDP, and that leaves very little fiscal space, so work needs to be done there. However, the current proposals are not very indicative of, at least in the short term, that is going to happen, so there's still ample uncertainty on what is going to happen in Brazil. Can a debt problem cause a financial problem in Latin America at this point? Can that develop into a banking crisis? And what we see here is that the level of exposure to government debt in the financial system is relatively moderate. Even in the cases of Brazil and Argentina that have the largest exposure, it's still moderate. Moreover, banking systems in Latin America are well capitalized. The regulation is the same for every single bank. We still don't know, with high interest rates, if there are going to be some problems in the system. So far, non-performing loans and capital adequacy and liquidity in banks remain very solid. So we don't expect problems to arise either from that side. However, and this is the last slide before I wrap up, the weakest point in the region, apart from low growth, is the social situation. After the end of the commodity boom in 2014, 2015, the process of decline in poverty and the decrease in inequality in the region pretty much stalled. And that started to create social problems and social unrest in several countries in the region. With the pandemic, of course, poverty levels increased due to unemployment in spite of the support of governments. That is something that was pretty much global. By now, poverty levels had gone back pretty much to the poverty levels before the pandemic, but we're still talking about high levels of poverty and high levels of extreme poverty in the region. Even though the conditions in labor markets went back to normal in terms of participation, informality, and unemployment, there's still this unresolved situation in the region. And that has a problem because with this situation, it is hard to implement some of the reforms that are needed to boost productivity. And it is difficult for governments to invest in things like infrastructure that could boost long-term growth because there are all these social pressures that need to be looked at. So, and to close, there are some key messages. The world economy will decelerate this year after a strong recovery over the past 2 years. Our baseline scenario is still that of a soft landing as opposed to a global recession, but uncertainty and financial stability concerns are clouding the outlook and introducing more risks to the downside. And for Latin America, following the rapid recovery of the past 2 years, growth would also decelerate this year to 1.2%. Most countries, and this is the good news, can withstand external shocks to a certain degree. I mean, not if there's a global recession, financial crisis, pandemic situation, but if conditions remain somewhat of what we're thinking about in the baseline scenario, the region can withstand these shocks. Inflation pressures are easing, that's good news, but until inflation does not go back to target, central banks in the region are likely to keep interest rates in a restrictive stance for monetary policy. There's scant fiscal space, and as I said, there still needs to do some work to recover fiscal space and debt sustainability in the medium term. And weaker growth will hamper the recovery of social indicators, and that could add some pressures and limit the scope for structural reforms in the region. And I'm going to stop here, and thank you very much for your attention.
Thank you, Adriana.